some of the companies would get credit lines from Silicon Valley Bank, and they could qualify based on the assets they had in the bank, or some of them would even get debt. And so there was a way that they were able to allow some of these things to help support the founder ecosystem. So now when founders don't have the access to credit or debt, they have to go out and raise via equity, right? And so they're going to go out and say, hey, we're going to go try to raise more money through a fundraise. And the way things are currently in the environment, there's so much layoffs, there's so much uncertainty with, again, the banks, with VC money actually flowing down to founders and at an early stage. So they're going to find themselves where maybe at one point they would have valued their company at 20 million. Now they're raising money at 10 million, which would then, what happens there is they now have to adjust their strategy to meet this new, what it's called a down round. And in the down round, then they'll have to lay off, employees. And then what'll happen is it'll give them a shorter runway to be able to grow the company. And they'll have to come back to the market again and say, hey, I need more money. And if there's no money available, then they're going to fail. I think I saw a stat that by the end of this year, there's going to be almost 50% of startup companies that are going to fail because of the access to capital. So we need breathing room right now. Rate hikes, just please, let us breathe. Let us figure a lot of this stuff out from how this is all going to play out through not only the banking institution, but how this is going to play out in the VC and startup ecosystem and the overall capital markets. Because even at the later stage, I mean, I worked at NASDAQ, they're also strained in terms of a lot of the companies that are delisting and dropped in value, and just the overall changes happening there.